We have a portion of our portfolio, we always call it our Ben Graham sleeve. It's about 10-15% of our portfolio. These are really cheap, typically small companies that we buy as net plays, where we're buying them at a discount to their cash and their current assets, their inventory, their receivables, net of all of their liabilities. We look at any given time, in recent few years, there's been 50 to 100 of these type of businesses out there. We went through a long stretch in the 80s and 90s where there were virtually none of these available. This was originally kind of popularized back in the Great Depression when Ben Graham was finding these kind of opportunities. In the aftermath of the Great Depression, Buffett was finding these kinds of opportunities in the 50s when he was running the Buffett Partnership. Then they vanished from view for many years. They briefly returned in the 70s, the mid-70s, during the recession and the bear markets of the early 70s. Then they vanished again, and for most of my investment lifetime they never existed, and I was always fascinated reading these old books like Intelligent Investors, just wishing that someday we'd find these kind of opportunities. Never thought I'd see them. Then 2008 and 9 happens, and lo and behold, there's hundreds of them popping up on our screens. Negative enterprise value, 50% of net asset value, net current asset value. We love to look at that basket of stocks and to see what are these businesses. A lot of them you can cast aside because there's obvious problems going on in the company. It could be a big lawsuit that they're facing. Tends to be the junk. There tends to be a lot of problems in these companies. But occasionally you'll stumble on one where you're getting a discount to NCAV, and you've also got an operating business sitting alongside of that is not losing money and is a call option. So you're buying downside protection through the NCAV discount, and you're getting a call option through the business that's sitting inside of the company. And if you take the time to go in and educate yourself, often you find some really interesting things. And if you see that management owns a lot of stock, that they're buying stock in the open market at cheap prices, you can find other reinforcing attributes. So we've always got a basket of those. We tend to not make them large positions. They tend to be 0.5% of our capital, at most 1% of our capital. You don't have any certainty as to when they'll pay off. I tend to find these are lightning strikes kind of investments. Many of them will languish for years and not pay off. But if one or two pay off, it can really pay for the whole basket, and you tend to not have big losers. I found over the 4 or 5 years that we've been doing these that there have not been any big, terrible losers where we've lost large percent of our capital. At worst, it's been sort of a break-even proposition. I also find that they don't correlate to the overall market. You'll find that when market sells off, these kind of stocks just hang in. They're operating on their own timeline. So that's one area of margin of safety.